Bloomberg Quint Live, and you're watching Trend Spotting with me, Shraddha Babla. Good morning, Agam.
Good morning, Shraddha. I'm Agam Vakil, and in the next 30 minutes, we deep dive into specific trends in the markets to draw out key takeaways and their implications for investors. First, the headlines. Tepid Tuesday for Indian markets as both benchmark indices trade with muted gains. Nifty manages to hold about 10,700, broader markets in line. And crude prices come off a 3-year high ahead of Donald Trump's decision on the Iran deal. Trump tweets that the decision will be announced tonight. And ICICI Bank is a top gainer on the Nifty after it manages to contain the gross NPA figure below 10% in the fourth quarter, despite RBI's new recognition norms. Congress withdraws petition challenging Vice President's decision to reject an impeachment motion against the Chief Justice of India, says wants to know if the bench's appointment was an administrative offer.
All right, the markets are off the day's high as of now. ICICI Bank alone, of course, is contributing as much as 30 points to the Nifty, while the HDFC Twins, Infosys and L&T are drags. The mid-cap index, we're seeing a marginal downtick there of about 0.1 or 0.2% or so. The small cap index is seeing outperformance. The last time I checked, it was up about 0.6%. Okay, that has also come off a bit in the last few minutes, but there's a mixed trend across sectors. The bank index is faring well, and that's probably largely attributable to ICICI Bank, which has a heavy weight, but the realty index is also trading stronger today, up about 0.7%. Media and auto are trading in the red, but overall the market breadth remains fairly distributed between gainers and losers. ICICI Bank, of course, gains as much as 7%, the biggest jump since October.
Well, Shraddha, on the losing end, we are tracking weakness in Tata Coffee. This is on earnings, which we've seen. It's clearly disappointed investors, and that stock is down as much as 6%. And the other earnings, which we also tracked post-market, was Trident. Trident is also declining by as much as nearly 5 to 6% right now. There you have it, down by as much as 5%. And some weakness there as well. I also want to mark PC Jeweler, and that's now down by as much as 11%. Or rather 10% now, but do remember extreme volatility in this counter, and we've seen a lot of traction along with its big change in implied volatility when it comes to this stock. Of course, currently at 217, no guesses for the direction in which this particular stock can move into. But what else are you tracking today, Shraddha?
Agam, I do want to highlight PNB Housing Finance, where there were a couple of block deals. In fact, 1.6 crore shares, which is 9.8% of the equity, has changed hands in 4 blocks. That was in the pre-open session. We did have information that Carvalho was looking to pair stake in the company. They were looking to sell up to 4.8% of their stake at a price of 1280 per share. That was a 6-7% premium to yesterday's closing price, and hence you're seeing that kind of pressure that we're seeing on the stock, down about 6%. Do remember that Carvalho is actually the largest shareholder in PNB Housing Finance, because while PNB held about 32.96% as of 31st March, Carvalho actually held about 37.33%. We did have an ET report a few days back, which did say that Carvalho was looking to sell up to 10% stake in the next 12 months or so. So this has come a little earlier, but that's probably the reason you're seeing that weighing on the stock, because otherwise the numbers for the fourth quarter were pretty good. But yes, this overhang of Carvalho selling stake, and also PNB selling stake because of that fraud and the need to raise money via non-core assets could actually continue to weigh on that stock. The numbers were fabulous. But Agam, yes, I do want to come to you, because the mid-cap IT is in spotlight again. Do we just know what is happening?
You know what, Shraddha, this is exactly, I carried out a study last week, and I, specified that a lot of the price targets for these IT companies in terms of the Bloomberg consensus are way below the prices at which they're trading at. They're clearly overbought right now. We did see a lot of volatility, a substantial amount of profit taking in the last week for stocks like Mindtree, Hexaware specifically in this case, which stands out, NIT Technologies to a certain extent, which of course did see a little bit of recovery after we saw its earnings. The point here, of course, is that the fact that we did see some amount of weakness last week because of the fact that they were so so overbought. This shows a little bit of short covering. And a lot of analysts are of the opinion that we are likely to see some consolidation now, considering the kind of moves that we've seen in the mid-cap IT space specifically. Possibly a little bit of profit taking, and maybe they could go back to the consensus target prices for now. But of course they're up and about right now. We'll just have to wait and watch when we do see a little bit of correction, or perhaps there could be just a time-wise correction in some of these stocks for now.
Fair enough. So I don't know if it's time to start getting a little cautious, but clearly mid-cap IT is the flavor of the season, at least for now. But let's also tell you what mutual funds have actually done in April. Now investors have pumped in nearly 12,000 crores into equity mutual funds last month. That's a jump of more than 4 times on a month-on-month basis itself. So not all categories did see such robust participation though. Jayesh is standing by to take us through the breakup of all the mutual fund action in April. Jayesh, where have these flows gone into?
Shraddha, primarily gone into equity funds, and if you look at the entire basket of the categories that are disclosed by AMFI, the total inflow for the month of April was nearly 1,37,000 crores as compared to a near 50,000 outflow that we saw for the month of March. Equity funds, like you pointed out, more than 4 times pumped in over there. In fact, the pure equity funds saw 12,000 crores of inflow versus 3,000 crores for last month. If we have a look at some of the other categories as well, if we can go to that, you can see that liquid and money market flows also came in at about 1,16,000 crores as compared to outflow that we saw, and so did some of the other categories. ELSS specifically, to point out, this is the first month of the financial year. We see pick up in the activity for the months of Jan, Feb and March. So understandably, ELSS has seen lesser inflow in terms of the flows that it got. If you have a look at the assets under management, the total assets under management for the liquid and money market, that actually surged about 36%, while the equity assets surged 7%. Now, if you combine the equity plus the ELSS equity schemes, those funds AUM actually grew about 6.7%. And have a look at the balanced funds as well, which saw 5% increase in the total assets under management, and so did some of the overseas investments and the infra funds that we got. The interesting one over here, the gold ETF, the gilt funds also saw some bit of decline in the total assets under management for the entire month of April.
Jayesh, you also spoke to some of the top fund managers. What are they attributing these flows to?
So Shraddha, I've spoken to about 3 people. If you have a look at the first one, Jinesh Gopani from Axis Mutual Fund, he firstly mentioned that the total pure equity flows, those are back to Feb level, so that was encouraging for him. And also he pointed out that balanced funds have in fact seen a slowdown, so investors are closely watching out for the Karnataka election before pumping in more money into the market. The other one I spoke to, Sundaram Mutual Fund, and Mr. Sunil Subramaniam said that the reduced redemption helped the equity inflows and thereby also helped the assets under management. The asset under management likely driven by the large flows that we saw for the liquid and the money market space. The last one was Swarup Mohanty from Mirae Asset, and he said that the equity flow is starting to look better, and it is a good time for investors to start piling onto their long-term equity portfolios.
All right, Jayesh, thank you very much for bringing us all those details. With that, let's also tell you what we have lined up on Trend Spotting today. Will March quarter act as a healing element for Indian pharmaceutical companies? Well, we will get an analyst view from Cyndrella Carvalho of Dolat Capital. And could the upcoming Karnataka elections leave the oil marketing companies with a hole in their pockets? Well, we will connect with Sudeep, Anand of IDBI Capital for a broader view on expectations and more. We will cover all of this in the next 30 minutes. Right, the earnings season is upon us, and we have been putting the spotlight on each sector to get street estimates, and today the focus is on the pharma space. Now, to discuss the street estimates and the key factors that have been weighing on the Indian drug makers, joining us now is Cyndrella Carvalho of Dolat Capital, the senior research analyst there. Good morning, Cyndrella. Thank you for joining us. I just was checking the performance of the sectors over the last 1 month month or even on a year-to-date basis. So aside of PSU Bank Index, pharma continues to remain the worst sectoral performer this year. Even in the first few sessions of this month, in May itself, the pharma index has actually lost 3%. So what, according to you, is driving this weakness? Is it reflective of the fourth quarter expectations for some of these pharma companies?
So Shraddha, it's just started kind of, if we just look at we have just got two results from our coverage. So in that we have Biocon and Pfizer has reported. Both these numbers have been really good. I mean, ahead of our expectation. If we look at the entire underperformance of the sector, I guess the sector has been underperforming since last 2.5 years. We have seen lot of compliance action which has led to a lot of good approvals being still held, still under questions, whether they'll come or not, whether the facilities will be cleared or not. There is a double whammy with this. There is a cyclical change in the US generic business, which has been a high margin driving business for the entire sector. And this sector, I mean, the US generic has not been the best for the Indian pharmas after years of a break kind of. So like, the kind of margins we used to see in US have been really under pressure because of a lot of consolidation of buyers and a lot of many approvals coming in at one time. What happened, just to quote what happened with Cyndrella approval. So generic Cyndrella kind of, was a shortest lived exclusivity for Oro, and many players enter into it. So, and then we saw Lialda is another big approval which came by this year. Otherwise, there are not any such major exclusivities that has come Indian pharma way. So there is a lot, there is a cyclical change in US generic business is what I feel. It will change, it will take its own course of time, but coming to the Indian domestic business, that has been coming back to normal double-digit growth after the entire GST and demo effect behind us. So a lot of opportunity is still there on the table. But we will have to wait and watch for the US generic. So just to quote on the US front, even currency has depreciated in this quarter a lot. So this will also add to the benefit of the sector, but we are yet to see these benefits reflected in price for all the sectors per se.
Cyndrella, you did allude briefly to the earnings which have already come, that is Biocon and Pfizer. To take this forward, what have you made of the earnings and what do you make of valuations as things stand?
It's just the start of the earnings right now, so it will be too early to comment because, ultimately the earnings are decided by the biggies. So we have to wait for the DRLs, for the Suns, the Lupins and the Cipilas and the Oros of the world to come and to actually give us a brief sense on that. So if I personally feel that the valuations are at a very, very attractive level in the pharma space, but you'll have to be selective on the pack and wait for the right opportunity to come on each and every stock differently, because pharma in itself is a different model,
Cyndrella, sorry, if I may interrupt you, my question was specifically with Biocon and Pfizer, because if I'm not mistaken, this is in your radar and it is in your coverage list. I just wanted your opinion on Biocon and Pfizer specifically.
Yeah, so Biocon, this is one stock we have been identified long time ago and been very positive on in terms of the approval pipeline, the kind of pipeline the company has is expected to show a good signal. But then coming to the compliance status again on their Bangalore plant is what is raising a concern for us. So we were expecting earnings in terms of the commercialization to start from FY19 mid, but the compliance status we fear that might delay it to maybe the last quarter or even to the FY20. So we'll have to wait and watch the pegfilgrastim US approval. That is one of the key approval for FY19 from our earnings perspective. So we are closely watching the Form 483 which is due. So in terms of valuation, yes, the stock, we have a TP of 850, which is quite aggressive on the street. Given if pegfilgrastim comes their way maybe after some time, because it is delayed presently according to my understanding of the US FDA inspection of the Bangalore plant. So given that scenario, we wait and watch unless and until we get Form 483 for Biocon. In terms of Pfizer, I feel that the stock the company's earnings have especially been very much buoyant. If we look at the entire earnings for last 3 quarters, they have beaten our estimates consistently. So there has been a good performance by the company, not just at the margins level, even at the top line per se. Last 2 quarters were quite strong on the top line also. So we yet want to understand it at a more detailed level. But in terms of valuation, I feel we were already at 2,500 TP and it has already breached that. So we kind of wait and watch at this present at Pfizer. From a valuation perspective, but we want to further clearly understand the entire Pfizer scenario, given the Corex moving out, Meloran coming in from the AstraZeneca portfolio. So we would like to give a better outlook once we speak with the management.
Fair enough. Cyndrella, but overall from the sector, which do you think, or which are the companies which could possibly outperform and which could underperform? And also, how and if the base quarter effect will really play out for your domestic companies versus some of these US plays?
Versus some of the
US generic focused companies.
Shraddha, versus some of the
US focused companies.
US generics. Okay. So yes, of course. Yes, of course, Shraddha. I feel that the performance will be domestic driven because US generics will be purely driven by the approvals. So barring few players who have received approvals, like Cadilla's performance should be good this quarter, driven by the kind of the approval mix and the US base that it has. But the question is largely on the future approvals for in terms of Cadilla's earnings are concerned. Compared to that, even we feel that Oro's earnings will be good this quarter compared to and the other players in terms of domestic. We feel GSK and Sanofi should post good numbers. We are expecting Sanofi's earnings today. So we feel that domestic performance overall, if I compare the entire Indian pack, domestic will be much better compared to the earnings at US, and in US also it will be strictly driven by the whomsoever has the key approval in their pack will only outperform. Rest all earnings should see some pressure because we have not yet seen kind of a stabilized performance at US generic.
Okay, Cyndrella, we leave it at that. Thanks a lot for joining us and giving us an update on the pharmaceutical sector. Of course, we are still awaiting several of the larger companies to come and announce their earnings, after which we can have better idea about what we can expect from FY19. But moving across to the other sector, which will be in focus largely on account of not substantial changes in oil prices. So though oil prices have come off a 3-year high, fuel prices domestically have remained unchanged for the 15th straight day. With the general elections in Karnataka at the end of the week and on the ongoing earnings season, how are oil marketing companies likely to perform? Let's get an analyst view here. We have Sudeep Anand, Head of Institutional Research at IDBI Capital. Sudeep, good morning and thanks for joining us. What do you make of petrol and diesel prices remaining unchanged for the 15th straight day? This is a little bit of an anomaly, but not if you keep this into perspective, if you consider the ongoing elections. How are you expecting this to play on some of these listed companies?
So yeah, definitely when your crude oil price is moving slightly upwards, your petrol and diesel retail prices remain flattish for the last 14 days. This would be definitely negative for your oil marketing companies, but if you look at the stock performance over the last 2 months or 3 months, probably most of the negatives are already factored in. And in this quarter, actually, we are expecting strong numbers from all these 3 companies, especially BPCL, followed by IOC, and then probably HPCL.
Sudeep, a large impact of these companies not passing on the higher prices on would probably be felt on the marketing margins, as far as the three OMCs are concerned. Do you have any EPS sensitivity calculation that you have for every, say, $1 rise in crude oil price which is not passed on?
Yeah, so if you look at the sensitivity, your HPCL is definitely higher marketing leverage than your BPCL and IOC. And for every dollar increase in your crude oil price, these companies will have to increase by petrol and diesel prices by around 20 paise. And with the absence of 20 paise, your marketing margins, with the fall of 20% marketing margin for, say, HPCL, their EPS will be negatively impacted by roughly about 5 to 7%.
All right. So, Sudeep, in the next 12 odd months, there are states like Mizoram, Rajasthan, Chhattisgarh, Madhya Pradesh, all of which will go into polls ahead of the next general election. Would you rather stay away from these OMCs given the upcoming elections and, of course, given the fact that crude prices are trending higher?
I think we are forgetting an important point that your U.S. is likely to announce its position on your Iran sanction, and a lot of negativism is already built up in terms of your crude oil price, which has already crossed $75 if you look at the Brent. And even Iran had given a comment that they are looking at a fair price value of roughly about $60 to $65 per barrel against what Saudi wants, around $80. So overall, we believe that your crude oil price should soften from current level once this event will be over, and whatever outcome comes from your US. Because if you look at the Iran production, that is around 3.8 million barrels per day, which is about 12% of OPEC production. Even though some sanction comes, probably the impact on the actual production volume will be delayed. And at the same time, we are looking at the higher non-OPEC production data, which is offsetting the OPEC production cut. So net, we are not very hopeful that your crude oil price should sustain at these levels for the longer term. So we have a slightly bearish view on the market, on the crude oil price at these. So looking at all these things, we are actually liking all marketing companies at current level. I think most of the negatives are overdone, and we should start seeing some kind of a value emerging from these companies.
So, Sudeep, by bearish, you mean that you're expecting oil prices to eventually fall off, if not consolidate. In that case, what is your pecking order among the top three OMCs right now?
So my pecking orders are BPCL, then IOC, and then HPCL, because we believe that your incremental capacity of Kochi will start contributing from this year, so that there will be a significant volume growth for BPCL, and definitely IOC and then HPCL.
Okay, Sudeep, we leave it at that. Thanks a lot for joining us and giving us an update on the sector. We'll continue to track the movements of crude, which will be very crucial for the economy and, of course, some of these oil marketing companies moving on. But ICICI Bank remains in focus. It is trading with strong gains, and it has gained the most, in fact, since October 2017, despite the March quarter earnings taking a hit in the fourth quarter as RBI's new stressed asset norms kick in. There was a surge in both bad loan recognition as well as provisions, the proceeds, of course, they're involved. Will also see ICICI Securities stake sale come into play. We have Shraddha Babla giving us an idea about the big takeaways from the quarter. Well, Shraddha, largely in line with expectations, but what are the key highlights here?
Well, that's correct, Agam. That was bang on. It was more or less in line with estimates. No surprises came in surprisingly. So the net profit for the quarter halved to about 1,020 crores, supported to some extent by a small tax write-back, and also on account of those 3,200 crore gains coming in from selling stake in ICICI Securities, because if it was not for that, we would probably have seen a net loss during the quarter. But even on the business momentum front, that continues continued steadily. The domestic loan growth inched up to 15%, and retail loans were the key drivers with a growth of 21%. Talking about the RBI circular and the kind of impact that it had, well, it led to a gross addition of about 10,000 crores to the gross NPA. So not surprising that the gross NPA ratio almost jumped to a near double-digit number of 9.90%. Even with respect to slippages, they jumped from 4,400 crores to 15,700 crores. The good part, of course, is that the bank managed to wind down most of its watch list, or the drill down list as they call it. So from 19,000 crores in December, it reduced to 4,700 crores, and a lot of it moved into slippages. That apart, as far as recoveries and upgrades are concerned, they've managed to do a very good job there. The recoveries and upgrade number came in at 4,200 crores for the quarter as compared to just 1,100 crores in December, and so that helped them to some extent, supporting that bottom line number. With respect to NCLT, the bank did say that they have taken account of that RBI dispensation, where banks are allowed to provide a lower 40% on the NCLT exposures compared to the previous requirement of 50%. So at the third quarter end, they had an aggregate provisioning of about 46% or so. They've inched it up to about 50% or so, so not too much increase over there. So a lot of that provisioning came in only on account of the watch list reduction and slippages. That apart, the good news is that there was no divergence that was reported, that needed to be reported for FY17 audit. And even with respect to that entire controversy around the Videocon case, the Chanda Kochar did say that that matter wasn't taken up yesterday, and that the board has already stated their stance and there's nothing new to say. So overall, brokerages have also retained their stance. Two reasons: one, given that they believe that most of the stress recognition has been done, and second, valuations at this point don't look expensive.
Well, what is really interesting is that now broking houses are preferring ICICI to something like an Axis Bank or a Yes Bank, at least as of now. Thanks, Shraddha, for bringing us those details. But on to our special segment, Bloomberg Edge. That's where we have Yash Upadhyay, as usual, telling us about a pattern that the Bloomberg terminal has thrown up. Yash, over to you.
Well, good morning and thanks for that, Agam. A couple of trends popping up on the charts of specialty restaurants today. First of all, the MACD line, which is the one in white, has crossed over the signal line to form a bullish crossover, indicating that the prices may go higher from here. Now, this can be taken as an indication of the start of a fresh up move. As you've seen, the stock has been trading in a range with a strong resistance at the mark of 140. Now, it would always be best to not use a technical indicator in isolation. So we also have the 50-day moving average here, which is the pink line, and with today's move it has surpassed the 50-day moving average. And as we've seen in the past, the stock has went on to rally after bouncing back above the 50-day moving average back in June 2017 and somewhere around September of 2017 as well. So if you are a trader or a short-term investor looking to invest in specialty restaurants, this would probably be the best time.
All right, I hope if you're a trader, you've heard that specialty restaurants is what's passing on the charts today. Thanks for that, Yash. And with that, it's a wrap on this edition of Trend Spotting. Up next is Hot Money with Darshan Mehta. Keep watching.
Sorry,